Lewis. I work in the Entrepreneurial tax team here at Chiene Tait. In today's session, I'm going to give you a brief overview of the different employee share schemes and incentives that we offer. Share schemes are a popular way for companies to recruit, retain and incentivize key members of staff. They provide an alternative method to cash bonuses or salary increases to incentivize employees to get on board and contribute to the goals of the company. Share schemes revolve around the issue of shares or options over shares to the company's employees. This gives the opportunity for employees to participate in any returns in the event that the company is sold or declares dividends. Options give employees the right to acquire shares at a future date at a predetermined price. This is often where the tax advantage arises. There's a great deal of flexibility when it comes to share schemes, meaning that they can be designed specifically to suit the needs of the company and align with its financial targets. However, there are some exceptions to this with some of the HMRC approved share schemes. There's a range of different HMRC approved share schemes that are designed to offer tax advantages to the company and the recipient. However, there are other non-HMRC approved schemes that can be designed to provide similar tax advantages. Selecting which scheme is most suitable depends on the type of company and the goals it has. In our experience, share schemes are particularly popular with early-stage startup companies. This is because an employee share scheme can provide an effective method of remunerating employees, especially when cash is in short supply. Share schemes can also provide an effective succession planning tool. Where a company is looking to pass ownership to an employee, a share scheme can provide a tax-efficient method. Companies can also use share schemes as a method of restructure shareholdings. This is most common in early-stage companies where founders are looking to rebalance founder shareholdings or where a new key director is being hired. There are two groups of share schemes, those that are tax-advantaged and approved by HMRC and those that are not approved by HMRC and do not carry any predetermined tax advantages. HMRC-approved share schemes include the Enterprise Management Incentive, Company Share Option Plan, Share Incentive Plan, and the Save As You Earn scheme. Each of these schemes fill a certain gap in the market, and each hold their own advantages and disadvantages. Non-tax advantage share schemes are not predefined. However, they are usually described as long-term incentive plans or management incentive plans, and can be designed to meet the requirements of the business. The long-term incentive plan does not carry any predetermined tax advantages. However, that doesn't mean that they can't be designed to be as tax advantageous as possible and also be designed to offer a very specific incentive to employees. The Enterprise Management Incentive, or EMI, is the most common share scheme amongst our clients and can also provide the largest tax advantage to their employees. Using EMI, companies enjoy the flexibility to offer any full-time employees and some part-time employees options over shares in the company. They can also set certain performance-based conditions that must be fulfilled before the employee can exercise their options to receive shares. Options may also be exit-only, meaning they will only become exercisable immediately prior to the company being sold. EMI gives companies the chance to grant employees options over shares in the company where, in certain circumstances, the growth in value will be subject only to capital gains tax. I will explain how this works in a moment. The majority of small to medium-sized companies will qualify for EMI. However, there are certain restrictions in place to ensure that the scheme is not abused. There are a range of conditions that must be met by both the issuing company and the receiving employee if the options granted are to be EMI qualifying. These are listed on screen now. The main stumbling block for deciding whether you qualify for EMI is based on whether the company is undertaking a qualifying trade. There is a list of trades that are not eligible for EMI, including property development, farming, financial services, leasing, and a few others. There are also certain restrictions on the size of company and which individuals are eligible. The next share scheme on our list is the Company Share Option Plan, or CSOP. This is another commonly used tax advantage share scheme. The CSOP is often used when a company doesn't meet the rules for EMI but still wants to incentivize their employees by granting share options. As mentioned previously, it is usually the qualifying trade that provides the stumbling block for companies seeking to grant EMI options. The CSOP removes this hurdle as it is available to all limited companies regardless of the trade that they carry on. As with EMI, companies can select which employees or directors that they want to be included within the scheme. However, there's a certain cap on the value of options that any one employee can be granted, reducing the flexibility of the scheme. There's a range of conditions that must be met by the employee or director to qualify for CSOP options. The main one is the £30,000 cap on the value of options that can be held. There's also another restriction placed on the CSOP options that doesn't apply to EMI. Companies cannot select which exercise price they wish to grant options at. They must be granted at the market value agreed with HMRC at the date of grant. In addition, the option holder will only receive a favourable tax treatment if they have held their options for between 3 and 10 years. On screen is an example of how EMI and CSOP options are treated for tax. When options are granted with an exercise price equal to the market value at the date of grant, any gain that is accrued on the shares between the date of grant and the date of sale will be subject to capital gains tax only. This is applicable to EMI as long as the options are exercised within 10 years. However, CSOP options must be held for between 3 and 10 years for the entire gain to be charged to capital gains tax. Business asset disposal relief may be available, allowing the capital gain to be taxed at a reduced rate of 10%. However, the availability of this depends on whether the option is an EMI option or a CSOP option. For EMI, the employee must have held the option and/or shares collectively for at least 2 years in order to qualify for business asset disposal relief. For CSOP, the employee will need to hold over 5% of the ordinary share capital in the company and, unlike with EMI, the 2-year holding period only begins once the CSOP options have been exercised and the shares are held. The period of time that the options have been held is not counted. Both EMI and CSOP provide a significant tax advantage to employees, allowing them to pay capital gains tax on any gain received on their shares. However, EMI is more flexible, as will be shown in the following slide, and, in certain circumstances, can provide an enhanced tax advantage through business asset disposal relief. On screen now is an example of the tax treatment of EMI options that are granted with an exercise price below the market value. This is specific to EMI, as CSOP options cannot be granted with an exercise price of anything other than the market value at the date of grant. However, companies can choose any value they want to be the exercise price for EMI options. This allows companies to grant options to employees that will cost very little for them to exercise. In the diagram, the employee has been granted options at £1 per share. This is at a discount to the market value of the shares, which would have been agreed with HMRC through a share valuation at the time the options are granted. Where options are granted at a discount to the market value, an income tax charge will arise when the options are exercised, as can be seen by the middle bar of the graph. However, income tax will only be charged on the lower of the difference between the exercise price of the options and the market value at the date of grant, or the exercise price of the options and the market value of the shares at the date of exercise. When the employee comes to sell the shares acquired through an EMI option, they will be taxed on the gain in the value of the shares from the market value at the date the option was granted and the market value of the shares when they are being sold. This gain is charged to capital gains tax and, as mentioned previously, due to the advantage provided by EMI, they may be able to take advantage of business asset disposal relief. It is also worth noting that the options will cease to receive the favourable treatment if they are held for over 10 years. However, the tax treatment in this situation gets complicated. There are other scenarios where the tax treatment gets complicated. However, for simplicity, I have ignored these for now. Long-term incentive plan is a general name given to share schemes and plans that are not HMRC approved or tax advantaged. These plans are usually designed by tax advisors to perfectly suit a company's needs and are generally used where the other HMRC approved tax advantage share schemes are not suitable. They usually involve the issue of shares to employees rather than options, as this provides a more beneficial tax treatment. A common feature in these types of schemes are hurdle and growth shares. Hurdle shares provide the holder proceeds on sale if the company is sold above a certain value. Growth shares operate in a similar way. However, they often involve the percentage of proceeds available to the holders increasing as the prospective sale value of the company increases. Hurdle and growth shares are used for several reasons. They provide incentive for employees, which is hoped will help drive the company's growth, which the employee will directly benefit from. These shares are also valued lower than other share classes, due to the value of the shares essentially being based on the hope that they will increase in value by assessing a potential future return. This means that the income tax charge for employees is lower than simply issuing ordinary shares. Long-term incentive plans also include phantom share plans. Phantom share plans involve the issue of bonus payments to employees rather than shares, but the size of the cash bonus issued is linked to the performance of the company and is based on its value. These are useful when shareholders are opposed to issuing shares to employees, which will dilute their holdings, or where the company has a strong enough cash position to pay bonuses. A bonus is, of course, usually less tax efficient for the employee. When shares or options are given to employees, they will fall within the employment-related securities regime. This is because they have been given a security in the company by reason of their employment. The ERS regime stipulates when and if income tax and national insurance may be charged on the issue of shares or options. However, these rules are extremely complex. Care must be taken when issuing shares or options to employees to ensure that there are no unexpected tax charges that may arise on the company or employee. Where share or options are issued to employees, annual returns must be completed by the company each tax year. There are a couple of other tax-advantaged share schemes that are approved by HMRC. However, these are less commonly used in high-growth companies. The Save As You Earn scheme is a savings-related scheme that allows employees to save money each month with the prospect of buying shares at a fixed price at a later date. This scheme is not a discretionary scheme like EMI and CSOP, as all employees of a company must be invited to partake in the scheme. The administration of this scheme is also a lot more complex than others mentioned previously. They are also most popular with large quoted companies. Share incentive plan is more complex to set up and administrate and also features a more complicated tax treatment than EMI or CSOP. The shares are held in a trust before being allocated to employees and requires regular share valuations to be undertaken to ensure that the correct value of shares is being issued to each employee. If any of these schemes are of interest to you and sound like they could be a great tool for your business, we would be delighted to discuss further. We will listen to your company's needs and design a scheme that is perfectly suited to your goals. We can undertake share valuations, liaise with HMRC, and we will liaise with your lawyers to ensure that all of the relevant documents meet the HMRC rules of the chosen scheme and will deliver the desired results. We will also frequently present to employees to detail the benefits of the scheme and the appropriate tax treatments they will face. We will also handle the administrative burden of the scheme and ensure that all records remain up to date to ensure compliance with the HMRC rules. If you're interested in anything that has been mentioned today, please do get in touch and we can have a call to discuss your company's needs.